Hello, folks. It is good to have you here. We need to talk about a shift that is going to define the next decade of your financial life, and frankly, it is something the mainstream news is barely touching. You see, while everyone is distracted by the noise, a silent tectonic shift has just occurred in the global markets. We are calling it the $688 billion exit. The big question we are answering today is exactly why China just sold United States debt at a record loss. This is not standard portfolio rebalancing. This is a strategic move that signals a massive change in the global order. If you want to understand what is coming, you have to look at this number, because when the second largest economy in the world takes a record loss just to get out of our currency, they are sending a message that we cannot afford to ignore. If you want to understand the timeline of the coming global conflict, you must stop looking at the movement of aircraft carriers in the Taiwan Strait. Military assets are deceptive. They can be deployed for training exercises. They can be used for signaling, and they can be recalled to port in a matter of days. They are the theater of geopolitics designed to be seen. If you want to know the intent of a superpower, if you want to know if they are truly preparing for an irreversible divorce, you must look at the movement of sovereign debt. Debt is the bedrock of the global order. It is heavy. It is slow. It takes months, sometimes years, to offload significant positions without crashing the market. And when the second largest economy in the world begins to dump the debt of its primary rival at a speed that defies economic logic, they are not rebalancing a portfolio, they are clearing the decks for war. We need to conduct a forensic deep dive into the data released by the United States Treasury Department this week. The Treasury International Capital Report is one of the most boring, dense, and critical documents in finance. Most journalists skim the headline number. We are going to read the footnotes. The data confirms a trend that Wall Street has been trying to ignore, dismiss, or spin for the last 12 months. China OS official holdings of United States Treasury bonds have collapsed to $688 billion as of October 2025. To the uninitiated, $688 billion sounds like a lot of money. It is, but in the context of the United States and China financial relationship, this number represents a catastrophic collapse. This is the lowest level of Chinese ownership since May 2009. We have erased 16 years of financial integration. To put this in perspective, in 2013, at the peak of the symbiotic economic relationship between China and America, Beijing held $1.32 trillion in United States debt. They effectively funded the United States deficit. They bought the bonds that allowed Americans to buy cheap Chinese goods. It was a closed loop of capital flow that kept interest rates low and global trade humming. That loop is broken. China has liquidated nearly 48% of their position from the peak. They have sold off over $600 billion worth of American IOUs. But it isn't just the total amount that is alarming. It is the market context of the recent sales. Throughout late 2024 and throughout 2025, the United States bond market was in a historic drawdown. Interest rates were volatile and bond prices, which move inversely to yields, were depressed. Anyone selling United States treasuries during this specific window was selling at a realized loss. In the world of asset management, you do not sell a depreciated asset for a loss unless you are facing a liquidity crisis. You need cash immediately to pay bills, or you believe the asset is about to become toxic. We know China is not facing a liquidity crisis. Despite their domestic real estate struggles, they continue to run a massive trade surplus with the world. They are swimming in cash. Therefore, the only logical conclusion, the only one that fits the data, is that the strategic decision makers in Beijing have decided that the United States Treasury bond is no longer a store of value. They view it as a strategic liability. This is the sanction evasion signal. We must look at this through the lens of February 2022, when Russia invaded Ukraine. The United States and the European Union executed a financial maneuver that shocked Beijing to its core. Overnight, they froze $300 billion of the Russian central bank's foreign exchange reserves. These were funds sitting in Western accounts in New York, London, and Brussels. Russia thought this money was safe. It wasn't. It was seized or immobilized with a few keystrokes. Beijing watched this, they analyzed it, and they realized a terrifying truth. If we make a move on Taiwan, or if the South China Sea conflict goes hot, our United States Treasury holdings are not an asset. They are a hostage. The $688 billion they still hold is effectively a donation to the United States Department of Justice waiting to happen. The moment sanctions are applied, that money goes to zero. I want to pause here and ask you a question because this is critical. Do you think the decision to weaponize the dollar against Russia was the trigger that scared off the rest of the world? Or is China just using that as an excuse? Let me know your thoughts in the comments below. I really want to see where you stand on this. So, they are getting out. They are liquidating the position with extreme prejudice. They are willing to take a 10% or 20% haircut on the face value of the bonds today, rather than risk a 100% loss tomorrow. This is a strategic liquidation. It is the financial equivalent of a burn notice. They are dismantling the Great Wall of debt that stabilized the United States economy for 20 years, and they are doing it in a way that suggests urgency. Usually, the central bank tries to hide its selling to avoid spooking the market. They sell slowly in small chunks. But the velocity of the recent drop, shedding nearly $12 billion in October alone, suggests Beijing is less concerned with market stability and more concerned with capital flight. They want the money out of the United States jurisdiction, and they want it out now. This has profound implications for the American economy. For 2 decades, the United States government could run massive deficits because there was always a price-insensitive buyer in the East. China would buy the debt regardless of the yield because they needed to recycle their trade surplus. That buyer is gone. China has turned from the biggest buyer into the biggest seller. This creates a massive supply and demand imbalance in the United States bond market. Who is going to buy the debt that China is dumping? Who is going to fund the deficit now? As we will see, the burden is falling on the Allies, specifically the United Kingdom and Europe, who are being forced to cannibalize their own economies to keep the United States financial system afloat. When the second largest holder of your sovereign debt decides to dump hundreds of billions of dollars onto the open market, basic economics dictates that the price should crash. When supply floods the market and demand vanishes, prices fall. In the bond world, when prices fall, interest rates and yields skyrocket. If market forces were allowed to work, the exit of China should have pushed United States 10-year Treasury yields significantly higher than where they are. This would be catastrophic for our economy. It would explode mortgage rates, it would bankrupt regional banks, it would make the interest payments on the national debt unsustainable. But curiously, that hasn't happened yet. Rates have risen, yes, but the market hasn't collapsed. Why? Because as China steps out, the Allies are being forced to step in. We need to look closely at who is buying in the data. While the line item for China is plummeting towards $600 billion, other line items are spiking to historically abnormal levels. Specifically, the United Kingdom and Belgium. The United Kingdom's holdings of United States debt have surged to record highs, reaching over $750 billion in late 2025. This puts the UK neck and neck with China as the second largest foreign creditor to the United States, after Japan. Think about that for a second. The economy of the United Kingdom is roughly 1/6 the size of China's economy. The UK does not run a massive trade surplus. In fact, Britain runs a trade deficit. So, where is Britain getting the money to buy nearly $750 billion of United States debt? They aren't buying it with excess profits like China did in the 2000s. They are likely buying it with borrowed money, or through financial engineering in the City of London. The UK is effectively leveraging its own balance sheet to act as a shock absorber for the United States Treasury market. Then there's Belgium. In the latest data, Belgium's holdings are roughly $320 to $370 billion. Is the Belgian government suddenly flushed with cash? No. Belgium is home to Euroclear. Euroclear is one of the world's largest international central securities depositories. It is the plumbing of the global financial system. When you see Belgium buying United States debt in the report, it is rarely the Belgian government. It is usually a proxy. It is often other central banks, sovereign wealth funds, or custodial accounts trying to mask their activity. It creates a layer of anonymity. However, the surge in Belgium and UK holdings occurring exactly as China sells suggests a coordinated effort by the G7 nations. This is the Bagholder Alliance. This is not a free market decision. Why would a rational investor in London or Brussels aggressively buy United States treasuries right now? Does this sound like a free market to you, or does it sound like a rigged game? If you're skeptical about these sudden buying sprees by our allies when everyone else is selling, type the word rigged in the comments. I want to know if I am the only one seeing this manipulation. The United States is running a $2 trillion deficit. Inflation is sticky. The currency is being weaponized. Buying United States debt right now is a risky trade. The fact that the Allies are loading up on it suggests geopolitical arm twisting. Washington is effectively telling its partners that China is dumping, and if they do not step in and absorb this supply, the bond market breaks. If the United States bond market breaks, the global financial system breaks, and we cannot protect you. It is a form of financial conscription. The West is cannibalizing its own balance sheets to absorb the supply coming out of Beijing, but this strategy has a fatal flaw: capacity. China had a seemingly infinite capacity to buy debt because they were the factory of the world. They earned real dollars by selling real goods. The UK and Europe do not have that capacity. They are already struggling with their own debt burdens, slow growth, and energy transitions. By forcing them to buy United States treasuries, Washington is draining the liquidity from its own allies. It is weakening the periphery to save the core. This creates a fragile system. If the UK economy stumbles, as we saw during the crisis in 2022, they might be forced to sell those treasuries to raise cash for themselves. If that happens, the bid of last resort disappears. China knows this. China is playing a game of attrition. They are bleeding the West dry. Every $1 billion of bonds they dump forces the Western financial system to find $1 billion of liquidity to buy it. It draws capital away from productive investments like factories or infrastructure and into the black hole of refinancing United States debt. It is a weaponized sell-off designed to exhaust the financial capacity of the G7 before the kinetic conflict even begins. Furthermore, this shift changes the nature of the United States bond market. It used to be a market dominated by economic buyers like China and Saudi Arabia, who bought for profit and trade. Now it is a market dominated by political buyers like the UK, Belgium, and Japan, who buy for diplomatic survival. Political buyers are fickle. They buy until their own voters revolt or until their own currency crashes. We are watching the transition from a global reserve asset to a NATO reserve asset. The market is shrinking. The pool of buyers is getting smaller while the issuance of debt is getting larger. And while the West is busy shuffling paper liabilities among themselves, China is taking the cash and running to the one place the United States Treasury cannot touch, the physical world. When China sells a United States Treasury bond, the transaction settles in United States dollars. The central bank receives a digital credit in a custodial account. But here's the problem. China doesn't want dollars. As we established, dollars are a liability. They are traceable, sanctionable, and subject to inflation. China is exiting the dollar to escape American leverage. So what are they doing with the proceeds of this massive $700 billion exit? They aren't putting it under a mattress. They aren't buying euros, which are just United States vassals, and they aren't buying Japanese yen. They are engaging in the most aggressive commodity accumulation drive in modern history. They are converting paper claims into physical reality. We need to track the cargo ships entering their ports to see where the money is going. While Western analysts stare at bond yields and stock tickers, Chinese state-owned enterprises are swallowing record amounts of raw materials. This is not a commercial inventory build. This is a strategic hoarding campaign. First, let's examine the golden pivot. As we have discussed previously, the central bank has been a relentless buyer of gold. Officially, they have bought gold for 18 plus consecutive months. Unofficially, the withdrawals suggest the buying is much larger. They are using the dollars from the bond sales to buy metal on the London and Swiss markets and shipping it east. Gold is the ultimate anti-dollar. It has no counterparty risk. It cannot be frozen by the SWIFT system. By swapping United States debt for gold, China is moving from credit-based reserves to collateral-based reserves. Second, we need to address the energy lifeline, specifically crude oil. China imports 70% of its oil. This is its strategic Achilles heel. In a war, the United States Navy could blockade the trade routes and starve the Chinese economy of energy. To counter this, China has been buying record amounts of oil, often from sanctioned nations like Iran and Russia. They are paying in local currencies, bypassing the dollar entirely, but crucially, they are filling their strategic petroleum reserve to capacity. Recent data indicates China's crude stockpiles are nearing 1.5 billion barrels, which is commercial plus strategic capacity. Satellite imagery analysis shows the construction of massive new storage farms and underground caverns. They are building a buffer that would allow them to survive a naval blockade for months, perhaps years. The money for this oil is coming from the liquidation of United States assets. Third, take a look at the metal mountain comprising copper and strategic minerals. This is the most telling signal. China's property sector, historically the biggest consumer of copper for wiring and plumbing, is in a depression. Real estate starts are down. And yet, China's imports of copper ore and concentrate remain near all-time highs, with roughly 28 million tons imported in 2024. This defies standard economic logic. If you aren't building apartments, why do you need so much copper? Because you are shifting to a war economy. You need copper for the green energy grid to reduce reliance on imported oil. You need copper for munitions. You need copper for drones and electric vehicles. China is cornering the market on the physical inputs of the 21st century military-industrial complex. They are also hoarding cobalt, lithium, and rare earths. While the United States financializes its economy, China is materializing its savings. Fourth, consider the food security fortress. China creates 20% of the world's GDP, but has only 7% of the world's arable land. This is another vulnerability. In response, China has accumulated massive stockpiles of grain. According to the United States Department of Agriculture, China holds approximately 60% to 70% of the world's global reserves of corn and wheat. They have enough grain stockpiled to feed their population for over a year without a single import. They are trading yield interest on bonds for calories and survival. This is the fundamental shift in mindset. A nation that plans to remain at peace keeps its wealth in efficient interest-bearing financial instruments like United States Treasuries. It chases the highest return on investment. A nation that is preparing for conflict converts its wealth into inefficient physical stockpiles. Holding 500 million tons of copper pays no interest. In fact, it costs money to store. It has a negative yield, but it has a massive return on survival. China is willingly accepting a lower financial return today to ensure it cannot be strangled tomorrow. This explains the loss they are taking on the bonds. Western economists mock China. They say they sold at the bottom. They realized a loss of billions. This is short-term thinking. Beijing doesn't care about a mark-to-market loss in fiat currency terms. They care about resource security. If they sell a bond at an 80% loss, but use the proceeds to buy oil that they will desperately need if trade routes are closed, that is a winning trade. They are trading fake wealth that can be frozen or inflated away for real wealth that can be burned in an engine or fired from a barrel. The liquidation of United States treasuries is the funding mechanism for this stockpile. They are using the proceeds from the old system to build the bunker for the new system. We have analyzed the flow. The data is clear. The trend is undeniable. China is selling. The Allies are absorbing the blow with borrowed money. The proceeds are being funneled into hard assets that can survive a world war. The conclusion is simple, yet terrifying for the average investor. The United States Treasury bond has become a battlefield. For 40 years, the 60-40 portfolio, 60% stocks, 40% bonds, was the gold standard of investing. Bonds were the safe haven. They were the ballast that kept the ship steady. That era is over. The United States Treasury bond is no longer a risk-free asset. It is a political football in a global economic war. It is an asset class that relies on the kindness of strangers who are increasingly becoming enemies. If China, the ultimate insider of the global manufacturing world, is getting out, you need to ask yourself a very serious question. Why are you staying in? So, how do you position yourself for a world where the biggest buyer leaves the market? You follow a strict protocol. Rule number 1 is to shorten your duration. If you hold bonds, you must understand duration risk. Duration is a measure of how sensitive a bond's price is to interest rates. Long-term bonds, 20-year, 30-year treasuries, have high duration. If interest rates rise by 1%, the price of a 30-year bond can crash by 20%. As China exits, the structural pressure on long-term rates is upward. Even if the Fed cuts short-term rates, the long end of the curve, which is determined by supply and demand, not the Fed, is vulnerable to a buyer strike. If China sells and the UK taps out, yields must rise to attract new buyers. Rising yields mean crashing prices for existing bondholders. Therefore, do not hold long-term United States government bonds or ETFs like TLT. These are the assets most vulnerable to the Chinese sell-off. If you want safety and yield, keep your cash in short-term T-bills, 1 month to 6 months. Short-term bills have almost zero duration risk. They are less sensitive to the geopolitical dumping. They act as cash equivalents. Be like China. Get liquid, get short-term. Don't lock your money up for 30 years with a government that is fighting an economic war. Protocol rule number 2 is to follow the smart money into commodities. China is selling paper to buy stuff. You should consider doing the same. Your portfolio needs exposure to energy, metals, and real assets. This is not just about profit, it is about inflation protection. Think about the end game here. If China dumps $688 billion and the Allies eventually stop buying, who buys the debt? The Federal Reserve. The Fed will have to step in as the buyer of last resort, known as yield curve control. They will have to print trillions of dollars to monetize the debt. When they print trillions, the value of the dollar falls and the price of goods goes up. This is the inflationary loop. China knows this. That is why they are buying the physical goods now. You should own the producers of these assets. If China is hoarding copper, you want to own the miners that produce copper. If China is hoarding oil, you want to own the energy producers. If China is hoarding gold, you want to own the metal. These assets act as a hedge against the debasement of the currency. You want to own the stuff, not the currency that buys the stuff. Protocol rule number 3 is to watch the Allies. You need a warning signal. You need to know when the bag holder alliance is breaking. Monitor the currencies of the key United States allies, specifically the British pound and the Japanese yen. These countries are straining their own resources to support the dollar bond market. Japan, in particular, is the largest holder of United States debt. But Japan is fighting a currency crisis. The yen has been volatile. If Japan has to intervene to save the yen, they will have to sell United States treasuries to get the cash to buy their own currency. If Japan joins China in selling, it is game over for low rates. Watch the exchange rate. If the yen crashes towards 160 or 170, or if Japanese bond yields spike, it means the alliance is fracturing. That is the moment the United States Federal Reserve will be forced to intervene. That is the moment the pivot happens. Not because inflation is beaten, but because the Treasury market is broken. The $688 billion figure is not just a statistic in a government report. It is a countdown clock. China is methodically, deliberately removing itself from the United States financial system. They are clearing the decks. They are willing to take a loss today to ensure survival tomorrow. Do not interpret the current stability of the market as safety. It is an artificial stability propped up by political pressure and borrowed money. When that prop gives way, the adjustment will be violent. Get out of long-term debt, get into hard assets, watch the flows. The divorce is finalized. We are just waiting for the house to be sold. Let's bring this home to your kitchen table. It is easy to look at billion-dollar figures and feel detached, like this is a game played by elites in Davos or Beijing, but the consequences of this exit are going to land squarely on Main Street, specifically on your retirement. If you are watching this and you are over the age of 40, you have likely followed the traditional financial wisdom. Your financial advisor, your human resources representative, and every pamphlet you have ever read has told you the same thing. As you get older, you should own more bonds. They call it de-risking. The idea is that stocks are for growth and bonds are for safety. They tell you that when the stock market crashes, bonds will go up and protect your nest egg. That advice is now obsolete. In fact, it is dangerous. By holding a traditional portfolio heavy in long-term United States debt, you are effectively standing on the train tracks while the freight train of global de-dollarization is barreling towards you. Think about your pension fund. Think about your 401k. These massive pools of capital are legally required to hold huge amounts of government debt. When China sells and yields rise, the value of those bonds in your retirement account drops. You might open your statement next quarter and see that the safe part of your portfolio has lost 10 or 15%. That is not supposed to happen, but it is happening. This is the great wealth transfer. The purchasing power is being transferred from the holders of paper assets to the holders of hard assets. We also need to talk about the standard of living. The reason the United States has enjoyed a high standard of living for decades is partially because we export our inflation. We print dollars, send them abroad, and get cheap TVs, clothes, and electronics in return. China hoarded those dollars, keeping them out of our domestic economy. Now, that flow is reversing. As China sells treasuries and buys commodities, they are effectively sending those dollars back home. When those dollars come home, they chase goods and services here. This means the inflation we saw in 2022 was not a glitch. It was a preview. We are entering an era of structural inflation. This means higher prices for energy, higher prices for food, and higher prices for everything you need to survive. The government will try to mask this. They will change the way they calculate the consumer price index. They will talk about transitory factors. Do not listen to the words, watch the wallet. I want to hear from you on this because the government statistics often hide the truth. What is the one item in your monthly budget that has skyrocketed the most in price? Is it insurance? Is it beef? Is it your property tax? Leave a comment below. We need to document the real inflation rate, not the official one. If your grocery bill is up 30% and your bond portfolio is down 20%, you're being squeezed from both sides. This is why the protocol we discussed earlier is so vital. It is not just about getting rich. It is about preserving what you have worked for your entire life. You cannot rely on the systems that worked in the 1990s or the 2000s. Those systems were built on a cooperative relationship between the United States and China. That relationship is dead. You have to fight the psychological urge to normalize this. It is called normalcy bias. The human brain is wired to believe that tomorrow will be roughly the same as today. We assume that because the United States Treasury bond has been the risk-free benchmark for 80 years, it will be the benchmark for another 80. History tells a different story. Empires rise and empires fall, and the currency is always the last thing to go. When the British pound lost its status as the world reserve currency, it didn't happen because the UK disappeared. It happened because they exhausted their balance sheet fighting wars and relied too heavily on foreign creditors. Does that sound familiar? We are repeating history, rhyme for rhyme. Finally, do not expect a formal announcement. There will be no press conference where the president declares that the bond market is broken. It will happen gradually and then suddenly. It will look like a glitch in the overnight lending markets. It will look like a sudden spike in yields that the news blames on a technical error. Most people will sleepwalk through it until it is too late. But you're here. You are paying attention. You have the data. The $688 billion exit is the smoke. The fire is coming. It is time to fireproof your house. Stay liquid. Stay alert. And most importantly, do not bet against the physical reality. Paper burns. Copper and oil do not. We will be monitoring the situation closely as the next Treasury report comes out. Until then, stay safe.